Welcome to today's video here at Taxes Explained. The goal of today's video is to briefly go over at a high level the U.S. tax system, kind of talk about some of the misconceptions surrounding it, and I'm hoping this video will be as simple as it can be without any advanced or bougie accounting and tax jargon. So first, I think it's important for us to decipher the difference between gross income and taxable income. There's what you earn, and that is gross income. It's what you earn. But then there's also what you get taxed on. And what you get taxed on is called your taxable income. The gross income is that number you see when you sign an employment contract. And the taxable income is a number you don't see anywhere until you go to actually pay your taxes. So these two numbers should pretty much always be different, and taxable income should be lower always than your gross income. So for a brief example, let's say that our gross income is $60,000. And this is that number on that employment contract. You will earn $60,000 a year. That's obviously not how much money we take home. So what is our taxable income then? How do we get from that $60,000 of gross income to our taxable income? This is where deductions come in. And for this video, we're only going to talk about the standard deduction, but in a future video, we can go over itemized deductions and the other various things you can do to lower that taxable income number. And so the standard deduction is a very easy deduction you can take without having to do anything. You just file your taxes and you say, I'm taking the standard deduction. So these numbers change year over year and they depend. Are you single? Are you married, filing your taxes with your spouse? Are you head of household, which is another term? But for 2025, for single filers, you can claim $15,000 in standard deduction. And if you're married, filing with your spouse, that number is $30,000. So going back to our previous example where we had that gross income of $60,000, gross income of $60,000, we're going to take the standard deduction and we'll just be single for now. We're single. So we'll get $15,000 of that standard deduction. And all you do is you subtract $15,000 from it and you get $45,000. And that is our actual taxable income. And all we did was just say, I want to take the standard deduction. And again, there's other ways you can go about lowering this number. But again, for this video, I think it's just, we'll keep it at the standard deduction. And this is how you get to taxable income. This is the number the IRS cares about. Moving on to tax brackets. I think this is the biggest misconception, and for good reason. The tax system in the United States is progressive. So for your first $11,600, you're getting taxed at 10%. And then you make one more dollar, you get that taxed at 12%. So from $11,601 to $47,150, that's getting taxed at 12%. And then you go into the new tax bracket, 22%. And all the way up to where we all hopefully want to be one day in that 37% tax bracket, making well over $600,000. Of course, not a lot of people hit that number, but this is how it works. It's a progressive tax system, and this is the actual tax bracket for 2025. So in our example, we had $45,000 in taxable income. After we took that standard deduction, we went from 60 to 45. So let's figure out how much we owe in tax. So for that first $11,600, we're getting taxed at 10%. So the tax is $1,160. But that's not all of our money. We have more money to be taxed on. That bucket is going to be the 12% bucket. So we have the remainder, $33,400 times that 12%. 12%, that's going to give us $4,008. And now that's it. We don't have any more taxable income. So we would just add these two numbers together, and it gives us total tax of $5,168. and that is how much money we're going to pay in taxes. I think the big misconception here is people will see their taxable income is $45,000 and they'll say, okay, I'm in the 12% tax bracket. And that's what I'm getting taxed on. That's it. But that's not actually how it works. So if you assume that, you would say, okay, 45,000 times 12%, and that gives me a tax of this. That number's higher, and it's also wrong. So it's important to understand, the difference in how it's a progressive tax structure. All right, moving on to withholding and refunds. So throughout the year, your employer withholds taxes from each and every paycheck. I think this is something we're all very familiar with. But I will, illustrate it with a brief example. So we're making $60,000. We'll keep that going. We make $5,000 a month gross. That's our gross pay. Our employer, let's just say they're going to withhold $600 each and every monthly paycheck. That gives us a net pay of $4,400. And that is, the net pay that we actually get into our checking account every single month. So throughout the year, if your employer takes out and withholds more than what the IRS thinks you should, then you'll get a tax refund. If your employer does not hold back as much money as they should, then you're going to have to pay taxes when you go to file your tax return. And so let's say that we have our taxes owed for the year of $5,200. That's what we owe for the year. But throughout the year, our employer withheld taxes, and let's say that our taxes paid was $6,000. Taxes paid is $6,000. So obviously we paid more than what we owed, so we get a refund. We'll get an $800 refund for the year. Now, a lot of people say, oh, I got $800. This is great. I've seen some even higher than that. Oh, I got a $3,000 tax refund. And while it may feel good in the moment, that's money you could have had throughout the year. You just gave that money to the IRS basically on an interest-free loan, and they're just giving it back to you without the interest. So it's really important to try and get this refund number down to zero. You want to be in a position where you don't have to pay anything, but you're also not getting anything back, because that means you kept the right amount of money throughout the year. And in this case, that $800 could have been put towards whatever else you may need it to. And, a dollar today is not the same as a dollar tomorrow. And that's, another important thing to consider. All right, wrapping up with our takeaways from today's video, we talked about how gross income is not what you get taxed on. It's not our taxable income. We then talked about how the standard deduction is the way to lower that taxable income. And again, there's more deductions we'll talk about in future videos. Then we went over how tax brackets are a tiered or progressive system where you fall into different buckets as your money, increases, and you don't get taxed at one number. And then we talked about how a refund, that means you overpaid. And it may feel great in the moment, but remember, that's money we could have had throughout the year.